The month of January is done, and here we are on my birthday of all days on February 6th, looking back to see exactly what happened, looking forward to see what's coming this month, so we can see if anything caught us off guard or if we should expect anything different than our predictions that we made last month. Let's dive right in. So if you are new here, welcome. But if you are not, and most of you have stuck around and been around for a bit, you know how this goes. We're going to start with where we are coming from, look at some charts and some visuals to see exactly what has happened. And then we get to the fun part of predicting what's coming, which obviously, again, nobody knows for sure. But I have a pretty good track record of looking at the data, looking at historical trends, and figuring out what's coming. So mortgage rates have stayed about flat all month. And really, if we go back over the last 2 years, they've been basically the same, floating between 6 and 7%. There have been some highs, some lows, but generally speaking, that's where we've been. That's where I think we should stay. Inventory did jump up from where we started the year at 204 up to 211. However, because of a flurry that actually happened at the end of January, which I didn't expect, we saw about 6 homes go under contract in the last few days of January, but those didn't get reported until the beginning of February over the last few days. So that caught me a little bit off guard, but that is not abnormal. If we go back last year, the inventory in the middle of February is lower than it started in the beginning of the month. But by the time we get to the end, there's about a 10% growth, or was a 10% growth between February 1st and February 28th in total inventory. So surprised, but not worried about it. Days on market still pretty stable, ticking upwards a little bit in the single family market, but again, no concern there. And prices are continuing to increase. That single family piece, particularly rising rather quickly. And again, talked about this many times in the past. A lot of that is because the homes that continue to sell are bigger and newer than the ones in the past. So don't get scared about, hey, a home that you could have had for $1 million last year is now going to be 18% more. It might, but I wouldn't quite go that far. So looking at these data points, something did jump out for once on here. Mortgage rates, obviously, compared to last month, they're the same. Compared to last year, they're actually a bit higher, about 0.5%. Inventory, again, higher than where we were last month, but down a little bit compared to where we were last year. But the big thing here is the consistency in the single family sale to list price, still about 96%. Now, the condo thing, again, here's what jumped out to me. If we look at this month, essentially this says, hey, a condo on average is selling for 97.34% of what the asking price is. Last year, it was 95%. So we can look at that and say sellers are actually getting more now than they may have been last year compared to what they were asking. Last year, remember, this is when mortgage rates did jump up into the fall, into November, December, and we're pushing towards 8%. So that did stymie some things. That did give some buyers the ability to get a couple percentage points off of that price, which is a win for them. New listings, we ended up higher than last year by about 10%, which is great. Still way lower than we saw in January 2 years ago. However, this is about where we should be, somewhere in between, one of the lowest on record and a fairly high one, all things considered. Now that lock-in effect continues to really weigh on homeowners here. Pending sales, that 10% increase in new listings has resulted in 16% more homes going under contract than we had last January. Now, I just put out a post in the Facebook group a few days ago with some stats that already got erased because of what I just mentioned a minute ago. That wave of homes that went under contract but wasn't marked when I made that post. It was looking like we had maybe 2 more homes than we had last year go under contract, but here we are with several more now, and our strongest January in 3 years. We'll see if that is an indicator of things to come. Closed sales, again, a strong January for sure. And we'll see what February brings there. But again, that sales number is a lagging metric, not a leading metric. The pending sales are really what I like to focus on. Months of inventory in that single family world is dropping like a rock, right? Just 4 months ago, we were pushing 8 months of inventory. Now here we are at about 5 months of inventory. So plenty of homes are still getting scooped up. Not a lot of single family homes are going on the market, and those that do, a decent amount of them are getting gobbled up, and that has resulted in a consistently strong price. Whether you're looking at the median or the mean here, on the rise once again over the last 4 months, but still, in line with where we were about 6 months ago when we had that first jump up. Here's where I mentioned the days on market creeping up. But again, if we were to go further to the left pre-pandemic here, this is still lower as far as your days on market go compared to what we had back then. Switching over to condos, again, incredible consistency here, floating between basically 4 and 5 months of inventory for 2.5 years now. Probably make it three in a few more months of the same. Prices are taking a ramp up here. And speaking of prices, going back to single family, I think we'll see another increase there. I do anticipate this one staying roughly flat instead of continuing to rise, just based off of what we have seen and the metrics and how it's calculated. Shouldn't see a huge rise. Days on market still consistent here as well. Now, the speed ratio. If we were to look back at January of 2024, we are slightly better. So a slightly stronger market. Nothing crazy, but it moved a little bit faster. And again, this metric looks at the amount of new listings compared to the number of homes that went under contract. In short, how many homes do we need to see listed in order for one to go under contract? How many new listings? So just under two, which is about where we've historically been, about 1.75. And I spoke on this. You'll see, if you're looking at this closely, you'll see that blue line, the 6 month comparison point jump upwards. I covered that last month. The short version is we had a very, very fast month of July that fell off the 6 month calculation. Therefore, it's jumping back up. Now, the fun part, what's coming? Mortgage rates, no change, really. I expect that they should stay the same. The Fed, thankfully, did not cut rates in January. It would have been completely unwarranted. I don't expect them to do any of that, at least for the first 6 months of the year. So just like last year, I think the economy and things that are unraveling as we speak, it's going to take some time to even out. And that typically leads to stagnancy. But time will tell. So I don't expect that, again, worst case scenario, things are horrible and the Fed actually has to raise rates, which is a very, very small chance of that happening. Is it possible the mortgage rates could creep up towards 8%? It is, which is why I have the high in 8% here for the year. But I don't expect, again, much use case for them to reduce their prime rate, and I don't expect there to be pressure in the investment market, the bond market, treasuries, to put downward pressure on this just yet. Now, that said, I did read something. The Trump administration is apparently focused on getting that 10-year treasury yield down. The 10-year treasury, if you're not familiar, is the metric that tracks most closely with the 30-year mortgage rates. So there are things that they can do policy-wise to impact that rate. And if that's the case, if they're truly worried about our debt being renewed at these high rates, then that could be a win for everybody. Again, there's going to be pain along the way, but that could get us lower rates once that policy starts to play out. Inventory-wise, totally normal. It's about what we saw last year as well. More new listings equals more sales. If we had more new listings and the same or fewer sales, that would tell me that the demand has dried up. The fact that that new inventory has been consumed and not just sat out there to dry, right, on the market, it tells me we still have at least, if not a slightly stronger market than we had this time last year, where buyers still want to come to Ocean City to buy a home, whether it's for rental purposes, whether it's for personal use, whatever it is. Still plenty of people interested in being here, and I don't think that's going to change ever. Now, prices, again, a very strong month. Increases in both buckets, the single families and the condos, and again, going forward, it's going to take something crazy like 8% rates to really put downward pressure on prices. I think the prices are more likely to rise faster than I had predicted, which was going to be another roughly 5% increase in the average sales price by the end of the year. I think the odds are greater that I'm low than that I'm high. I think prices are more likely to go up faster than down at all. So that's it for this one. No rant this time. If you have any questions, don't hesitate to reach out. But if you liked this, if you learned something, do me a favor and hit the like button down below and subscribe as well, because I'm going to continue with these all year long. Thanks for hanging out as always. I'll see you next time.